Imagine digging into the heart of a company, finding incredible underlying strengths, yet the market seems to be having second thoughts. What if you could get a direct line to understanding that tension, absorbing all the critical insights without, sifting through mountains of reports? Today, we're doing just that. We're going beneath the surface of Applied Materials, Inc., or AMAT. They're a major player in the semiconductor equipment industry. Our mission, well, to extract the most important nuggets of knowledge from a comprehensive analysis report on AMAT, everything from its core financial health to how analysts and the broader market are reacting. Our goal is for you to walk away truly informed with those aha moments that really connect the dots.
Exactly. And this isn't just a surface level look. Our source material is a pretty detailed sentiment analysis report. It compiles historical financial data from fiscal year 2019 through FY 2024, and it looks forward to, with analyst consensus estimates for FY 2025 through 27. Plus, it captures broader market sentiment right up to August 2025. So it gives us both the numbers, the quantitative stuff, and qualitative assessments, all distilled into a clear star rating system.
Okay, so AMAT. Big player, critical industry. You'd maybe expect their growth story to be straightforward, right?
Yeah.
But the report calls their current growth situation a fascinating inflection point. What exactly is shifting here? What does that mean?
It's a really significant shift, almost dramatic, in their growth profile. Historically, say from fiscal year 2020 through 2024, AMAT was just a growth powerhouse. We're talking a 5-year average of 16.7% for revenue and an impressive 26.5% for earnings per share, or EPS. That kind of performance earned them, a 4 or even 5-star rating in the report. Solid stuff. But now, the forecast for the next few years, fiscal 25 to 27, shows a sharp deceleration. We're looking at mid-single digits, like 4.5% for revenue, and maybe 10.1% for EPS. And that drops their growth rating right down to maybe a 2 or 3 star.
Wow, okay, from strong double digits down to mid-single digits. That's a huge shift. Why the sudden slowdown? Is the company itself struggling? Maybe execution problems?
No, not really. This isn't about them failing to execute. It's more of a market-wide thing, a cyclical adjustment. Think of the prior period, that 2020-2024 stretch, as a super cycle. The market was just hitting overdrive, driven by everyone needing more chips for remote work, cloud services exploding, the first big waves of AI investment.
The pandemic boom.
Exactly. And that demand meant massive capital spending from chip makers. And AMAT, being a key equipment supplier, was right in the thick of that boom. Now the market is, well, the report calls it digesting capacity, especially in China. After these huge investments in 2023 and 2024, chip manufacturers are just temporarily pausing new equipment orders. They need to utilize the capacity they just built up.
Okay, so it's a cycle thing, a headwind. How much does this really dent AMAT's longer-term growth story then? Is this just a blip we're seeing, or does it fundamentally change their path forward?
Well, the report lands the overall weighted growth rating at 3 stars, so average or moderate. The long-term secular drivers, think AI, Internet of Things, smarter cars, those are still incredibly strong tailwinds for them, no doubt about that. But the near to medium term, specifically fiscal 25 and 26, that's likely going to see what the report describes as lumpy and less predictable demand patterns. So yeah, it really marks a key transition for their growth, moving from those consistent boom times to something a bit more fluctuating.
Okay, growth-facing headwinds. That makes sense in a cycle. But, even if growth slows down, how well are they actually converting the revenue they do get into profit? The report seems pretty emphatic here, suggesting their profitability is like world-class, calls it a formidable attribute.
Oh, absolutely. It's probably their strongest point. They exhibit best-in-class profitability, earning a perfect 5-star excellent rating overall. And just to give you some context, for a company in this industry, excellent profitability usually means gross margin over 45%, operating margin over 25%, and return on invested capital, ROIC, above 20%. AMAT consistently clears all of those hurdles. It's quite remarkable, actually.
Okay, consistently exceeding those high bars. Can you give us some specific numbers?
Sure. Their 5-year average gross profit margin is sitting at 46.5%. Operating profit margin is near 28.7%, and net profit margin at 24.8%. What this really means is for every dollar of revenue, they're incredibly efficient at keeping a large chunk as actual profit. And then you look at how effectively they use their capital. Their ROIC is pushing 29%, return on equity, ROE, nearly 47%. Yeah, it tells you they're not just making money, they're really mastering turning investments back into more profit, consistently better than the industry benchmarks. These aren't just good numbers. They really demonstrate what analysts call a wide economic moat, a strong competitive advantage.
That best-in-class profitability, especially in a cyclical industry, sounds almost, well, almost too good.
Hmm.
Is there something analysts might be missing? Or maybe a hidden vulnerability behind those great numbers?
It really boils down to their technological leadership, especially in materials engineering, things like deposition and etch processes. These are absolutely crucial steps in making chips. And as chips get more complex, think about things like gate-all-around transistors, these tiny, complex 3D structures, or backside power delivery, moving wiring to the back of the chip.
Right, the cutting edge stuff.
Exactly. MAT's expertise becomes indispensable for making those things work. Their tech is really hard to replicate, and that gives them significant pricing power even when the market's a bit tougher.
Okay, so they're incredibly profitable, powered by tech leadership. The next logical question is, what do they do with all that cash they generate?
Hmm.
And how does that translate into financial resilience, especially, during a downturn like this potential slowdown?
Yeah, and this is another area where AMAT really shines. The report calls it a fortress-like balance sheet. It gets another perfect five-star excellent rating for financial strength. And in a highly cyclical industry like this, that strength is basically a strategic weapon. Their leverage, how much debt they use, is very conservative. A really low debt-to-equity ratio, the 5-year average was 0.43, and it actually dropped to 0.32 in fiscal 24.
So they're not weighed down by debt.
Not at all. It gives them immense flexibility. Plus, their liquidity ratios are excellent. Current ratio 2.56, quick ratio 1.82. They've got plenty of short-term assets to cover any obligations. But the real standout, it's their overwhelming cash flow generation. The cash they generate just from running the business, their cash from operations or CFO, could basically repay their entire debt load in less than a year. The CFO to total debt ratio averaged 115.8% over 5 years. It's astounding. In fact, the analysis suggests they're effectively operating with a net cash position, meaning more cash on hand than total debt.
So why does this kind of hardcore financial health matter to you, the listener, especially when growth might be slowing?
Well, think about it. This pristine financial health gives AMAT huge operational flexibility, while competitors might be forced to cut back on crucial R&D spending during a slowdown to save cash.
Right, tighten the belt.
Exactly. AMAT can keep funding strategic initiatives, like their big EPIC R&D center. This means they could potentially accelerate their technological lead over rivals precisely because others are pulling back. They can play offense when others play defense, and it also supports consistent capital return to shareholders. They have a very low dividend payout ratio, under 20%, meaning the dividend is super safe, and they have plenty of capacity for share buybacks even during leaner times. They simply have options others might not.
Okay, so let's sort of take stock then.
Mm.
If we look at the core fundamentals, growth, profitability, financial strength, how does AMAT stack up overall based on this report?
The final overall company fundamental rating comes out as a strong 4-star. The numerical score is 3.83, which translates to good or strong. So this confirms AMAT is fundamentally a strong, best-in-class industry leader. No question about the quality. However, and this is the key tension right now, that underlying strength is definitely being tested by the significant deceleration in growth because of the market cycle.
That paints a really clear picture of a very strong company fundamentally.
Hmm.
But as we know, the market isn't always rational, right? What does the report say about how analysts and maybe the broader market are actually seeing AMAT right now, especially with those growth headwinds you mentioned?
Right, and here's where the picture gets more complicated. Analyst sentiment is described as mixed and in a state of negative transition. It lands at a 3-star average or mixed rating. Now, on one hand, there's still a strong buy consensus overall from the 41 analysts covering them. About 34% have strong buys, 39% have buys. And their track record on earnings is excellent. They've beaten EPS estimates for the last 4 quarters with an average surprise of about plus 5.1%.
Okay, so far so good. But you said negative transition.
Exactly. The forward-looking indicators are decidedly more bearish. The report highlights what it calls a revision cascade. Basically, after their Q3 fiscal 2025 earnings report came out, there have been 9 downward revisions to the fiscal year 2025 EPS estimates just in the last month, and 0 upward revisions.
0 upward.
Yeah. And their guidance for Q4 fiscal 25 revenue, that $6.7 billion figure, it was well below what analysts were expecting, which was closer to $7.3 billion. That miss triggered widespread downward revisions across the board from analysts. And while the average 12-month price target is still around $195, which implies, maybe 20% upside from where the stock is now, around $162, it's really important to note that several analysts recently lowered their targets.
Okay, so analysts are getting nervous. What about the wider market?
Mhm.
The news headlines, what are people saying on social media or investor forums? What's the general vibe out there?
Well, that vibe has turned sharply negative. Broader market and news sentiment has pivoted sharply toward the negative, according to the report. It gets only a two-star rating, weak or negative. The dominant story you hear or read right now is squarely focused on that disappointing Q4 guidance, the stock's sharp price drop after earnings, and these lingering concerns about their business in China. Headlines are emphasizing weak guidance and falling revenue forecasts. It's often quite sensationalized, focusing on the short-term pain.
And social media, investor chatter.
Similar story there. Social media and investor forums show a leaning negative tone. The conversation is dominated by the cyclical downturn fears and the geopolitical risks tied to China. These immediate concerns seem to be overshadowing the longer-term AI growth story, which fundamentally should still be a major tailwind for the whole industry, including AMAT. And trader sentiment seems to reflect this negativity too. The report suggests there was likely a spike in put option buying, betting on the price falling further, and maybe increased short interest after that big post-earnings price drop.
So what this really boils down to then is this fascinating paradox, isn't it? You've got a fundamentally really strong company, excellent profitability, rock-solid finances, but the market sentiment, both from analysts becoming cautious and the broader public commentary, is decidedly weak and negative right now. It highlights a really clear disconnect between the underlying business quality and how it's currently being perceived.
That's exactly it. This deep dive really reveals a central thesis, I think. Applied Materials looks like a high-quality company, maybe available at a price that currently reflects a lot of short-term uncertainty and these cyclical headwinds. For investors, or anyone really with a genuinely long-term horizon, this period of cyclical weakness might actually represent an opportunity, a chance to acquire a premier asset in a critical industry while sentiment is down.
And for you, the learner, here's something to really chew on. Consider how a company's ability, like AMAT's, to keep funding its strategic R&D like that Epic Center, even during a market downturn. How might that actually widen its competitive moat for the next upcycle? It could create advantages that the current negative market sentiment just isn't capturing or maybe can't even see yet. It's definitely something to mull over as you think about how strong fundamentals truly play out over the long run.